Coming up on today's episode.
So the misconception of first-time buyers is that we mentioned about the assets. We mentioned about maybe a lack of planning.
Yep.
Simple question about, what's going to happen in the next 5 years. Maybe we are having aging parents, maybe overseas, like me, for example. That's been 2 or 3 years. I will have to go back at least once a year, every year, mandatory to look after my parents or things like that. Or,
of course.
Or I may have children's, in like 2 or 3 years' time. Or I already have children and, in 5 years' time, I may want to put them in private school. That's additional expensive. So that's very important, and that's linked to what a lot of first-time buyers tend to do, and we're all guilty a bit of that, is underestimate their spending and being a little bit too optimistic about their income.
Dodgy advice and bad decisions can cost you big in real estate. We're here to make sure that doesn't happen. Welcome to the No BS Real Estate Podcast. I'm your host, Jo Agresta, and it's time to take control of your property journey together. Welcome back, everyone, to the No BS Real Estate Podcast, your listening how-to guide to the Aussie finance and real estate market. I'm your host, Jo Agresta, and today's episode is one for all the first home buyers, future investors, and anyone who wants to understand why the right financial strategy is key to finding and keeping the right property. We're going to cover how investors should think about structuring finance for long-term success, why strategy beats chasing quick wins, the biggest knowledge gaps first home buyers have, and how to make sure you're setting yourself up for growth, not just more debt. And who better to have this chat with than Marc Cam, a mortgage broker who works with everyone from her first home buyers to seasoned investors. And he brings a really rare perspective to the table, from his days as a European architect to now helping Aussies secure their first homes. What a background. Marc, thanks for being on the show.
Oh, thank you. I'm very happy to be here to start with. And you're right, there's a lot to talk about when it comes to properties and property investments and for first-time buyers.
I know it's going to be a really action-packed episode because I've been so keen to talk to someone of your background. We had, when I first met you, we had our pre-interview, right, for the podcast. And I loved your story because it's so unique to anyone that's come into the finance industry. Typically they're coming in from banking, they grew up in a banking world or banking background, but Absolutely. You're quite different. Let's, start with your story. Where did your property journey begin?
Look, so it really began quite a while ago. My father was an architect, quite a successful one back in Europe, talking about the golden age of architects in the 60s, 70s, 80s.
That's amazing.
Right. So been around, drawing plans and things like that. So it started there. Then I ended up studying architecture. Kudos to my dad. He said, you're going to enjoy the studies, but it's going to be hard when you finish because the golden age is gone. And I remember my first day at uni back in Europe. The main director called us all in the amphitheater and said, you're going to be a mature architect when you turn 60. And we all look at each other. We were all 18 years of age.
Oh my God.
And I said, wow, that's going to be a long journey. So started with this, and through the studies, obviously connected to real estate, I often say to people, I learned how to design houses and the basic on that. And then the opportunity to travel. The sister here in Australia came here and did further studies, couldn't be an architect in Australia. So did a Bachelor of Business Management, get a connection in business, and got my first job as a property manager, which I think you experienced a little bit of property management.
Yeah.
Very interesting. So that bring me into how to manage the assets, and understand the landlords, tenants, the dynamic here, well more dynamic compared to what I see in Europe. So very interesting. And then I end up actually becoming an architect, but a different type of architect, PH architect. Yeah, understanding how to, now I know how to manage the assets, understand a little bit of the market, the residential market to be precise, Victoria in Melbourne, and now decide how can I help people finance and acquire real estate assets.
I think that, and this is why I wanted to have you here, Marc, because it's very unique to have someone that not only understands, good design of a home and structure, like you've studied it, you've worked in it, to then come into property management. And I think managing the asset is so important and it's very underrated. We often talk about all the money we spend to get the asset, and then as soon as we get it, we don't look after it
Yes.
until we have to sell it again.
Yes.
So I'm so excited to have your experience and your expertise here, because I've got a few questions that I know you're going to absolutely nail. And, like you said, you were, you worked 15 years back as an architect, and, 60 years old, that's a pretty rough age to be told that's when you're going to explode in the market.
Absolutely. Yes. And it's all done to, understand the business model in the industries, regardless of which kind of work you do. Going back on real estate, as you mentioned, how property managers are often understated. It's probably have to do with the business model of real estate. The director, the principal, the sales team, then property management team. They occupy a different space, pretty much.
Well, I was actually saying this to a property manager the other day. We were talking, and I said, isn't it interesting that real estate agencies always have the rent roll, because that's the asset, right? They might not like that department as much as they do their sales team, but that's the asset that is valuable to the business.
Absolutely.
And I'm like, why don't we have standalone rental property management companies? I never really see it's not common to have just a property management company, but far more common to have just a sales team.
Yes, and I will add to that as well. There's actually a lot in common with this business model of property management and then the sales, right, in the real estate. If you think about mortgage broking, with my own brokerage and so on, we get paid a trail commission. And we have like a book, which is a current of the rent roll for real estate. And that's the core value of our business. And a good broker should be also excellent at looking after the existing clients and these loan books. That's lots of similarity, actually.
Yeah, I see that exactly the way you put it. I didn't even think of it that way. It's true.
And guess what? A lot of brokers neglect a little bit to work on the book. And same way in real estate, said it's not about the result and so on. Hey, look after your landlord, look after your tenant proactively.
Yeah.
Don't be too reactive. If you're reactive, you're going to disappoint.
Yeah, it's true. What did your experience, because you're talking about property management, we're on topic at the moment. What did that teach you, your experience as a property manager, teach you about the Australian market?
Yes. So what it taught me, it pretty much told me very quickly that it's extremely dynamic in Australia. I mean, property turning around, changing hands much, much faster than it will be in France, for example, or in Europe overall. But talking about France, that I know a bit.
Yeah.
So therefore, it's dynamic. So you need to be a little bit proactive. There's rules and regulation, of course. They're changing a little bit. But it's also, as a property manager, what I've noticed, just based on the property managers, is even if you want to be ultra proactive and educate your landlords, so you need to factor all that in. But what I saw is like the property managers were often, put a bit aside, and they don't have that much weight in the communication with the landlord or tenant. I mean, with tenants, it's a different story again. But with landlords, I felt like, sometimes when we're doing rental appraisal or rent reviews, you need to take everyone on board. You need to see how your tenants is going.
It's true.
Bring a recommendation on the table that makes sense and it's fair for both parties. And I think when I left the industries, I thought, I'm not too sure that property managers get heard. Fair enough. Like the accountant probably have more say to it, which is great, but they don't necessarily see the value the same way. And property manager is here said, I'm not an accountant, don't get me wrong, but I do believe that if you do some maintenance in the property now, talk about it with your accountant, by the way, about the tax benefits and application that's come to it, but you may be a winner in 2 or 3 years time instead of leaving that on the side, and then it become a huge issue 3 years down the track when you actually need to fix it because now you need to sell the properties, or you can't increase the rent now because the property is no longer attractive enough to justify that. So
all right. And I think that experience, and again, it's another edge in the market for you, your clients must really value that perspective when you give it to them, because they're buying, like I said, you buy the property, we don't look after it. In your case, that's what you have been trained in, you've worked in it, lived and breathed it, and now you're getting to, educate those people that come to you for not only finance needs, but then you're also teaching them how to manage this moving forward.
Yes. I'm a mortgage broker, but I will share my opinions based on my experience in the past about, managing a properties, are you aware of this? And, it's a bit rusty now because, I don't remember the Tenancy Act on top of my head as I used to back in days when I knew it on my fingers. But, that I still know the basic, and I still remember like the obligation you have as a landlord, obligation that the tenant have as well. And how sometimes challenging it is to get the communication going.
Of course.
Parties.
No, I like that. And, there was it was something interesting that you said at the start of this episode, and it was, I didn't know this. So for anyone tuning in right now, you're about to learn something if you didn't know it. What did you tell me about the word mortgage?
Well, I told you first that you will learn a bit of French today. Mortgage is actually a French name. It's actually two words put together, more and gauge. Now, more, if I translate that to French, is death. And gauge is pledge. So when you take a mortgage, you take a death pledge.
What?
And that's, I often put it as, in my meetings with clients and so on, to say, look, it's a serious affair to take on a mortgage.
Yeah.
It's a death pledge, right? So my job is to look after you and have your best interest at heart. That's a priority number one. And tell you what you're signing up for. No big secret here or spoiler alert, but the banks, it's a necessary evil, and they're not in the charity business. Okay, so there is always a catches, and they don't give you something for free. There's no free lunch. Look at my rates. That's a shiny object. What is the trade-off? Is it going to be a bank that I can renegotiate my rates post-settlement? People talk a lot about getting there, taking the mortgage. I understand, and they need to understand the basic, of course. They also need to understand the appetite of the banks, and each banks have the appetite. First-time buyers, sell investors, people that will do principal and interest and then upgrade down the track and so on. Each bank has an appetite for the industries. They may like certain industries more than others.
That's true.
Nursing, emergency services. Yeah, people talk a lot about lawyers, doctors. Of course, they're there. Of course, they get. Banks will do what is in their best interest first.
Yeah, security.
Okay? So, what's exactly low risk? This is where you get all the goodies. The more, and I don't like to say more risky, the more atypical you are, the more you need to investigate which bank is a good match for you. Banks pretty much want to put you in boxes. And we are humans. We don't fit boxes. Or you may be across a couple of boxes.
That's true. Definitely me.
So I hope you learned a good French lesson here. Mortgage,
did.
Death pledge.
Death pledge. I love knowing that. I had no idea. So every time I'm saying to someone, are you going for a mortgage? Did you apply for a mortgage? Did you apply for a death pledge? So you guys have been hearing it this whole time going, wow, that's funny that they took that word.
Probably explain why so many French people choke when they come into my office in Australia. Because you have to, it's all based interest rate up. It's back with what the economy is doing and how the economy is progressing in your country, right? So the average home loans, I'm asking you a question, the average home loans in France, unoccupied, have a guess of what would be the interest rate as of today in 2025?
I wanna say it's low, like 1.5%.
Spot on. I know you've done your research as well. So you're on that 1.5, maybe 2% at the moment because it's not going up a little bit. Fully fixed, 20 years.
Whoa, really?
So now I have a lovely dual citizen or permanent resident.
Congratulations.
Come from from France, from Paris and so on. I said, look, at the moment you're looking at variable rate on occupied around 6%. Now the rates are starting to go down, but you're around 6%. I can see the color of the skin change.
Yeah, I can imagine.
Shaking. And I said, look, 30 years, Mark, I'm not going to go for a mortgage for 30 years. I said, look, good news, I'm in your team. And second thing as well, I don't have any clients that really keep a mortgage for 30 years. We structure it in the way that you get out of the mortgage before by paying it off sooner. And also a reality is, remember when I mentioned that the real estate business is quite, the real estate market is quite dynamic. Most of people turn over their properties, I think it was in Victoria, unoccupied 11 years, I think. Most likely your first home is probably not going to be your forever home.
Yeah, that's true.
Everyone is different. But so, a little bit of things like that. So quite interesting.
Well, this leads so perfectly, into the next part, because I want to talk about, the real talk with first home buyers, because you set it so perfectly. Everyone thinks, the death pledge, I'm going to call it that from now on. That's it. But when you're taking it out, it's a commitment for 30 years and people, are very daunted by that. Like you work with a lot of first home buyers. What draws you to that group in particular?
What probably back to the property management days, I think I like people and I really care about people. I think if you're property management or a bit in hospitality, it's a bit your passion, you're good with people. So first home buyers is the one that is more demanding in terms of education, but it's probably the one I take the most satisfaction out because you get to hold the hands of someone that is buying their first home. There's a lot to take on board and it could be very confusing. I mean, buying the house in the whole scope of things is probably the easiest part. Understand where to start, where the goalpost is. Another thing I'll put up there as well, I always say to everyone, I put it up there as well on my website and communication, never too early to talk to a mortgage broker. I much prefer having someone in my office that maybe doesn't even have a job right now. I said, okay, well, look, what do you want to do? I said, well, I'm planning to get my first job in 6 months' time and I would start on 70K package. What does that look like, Mark, in terms of like my borrowing capacity or whatever? I said, well, I already tell you, 70K, don't have any liabilities, no HECs included. You're single by yourself, you're below 40 years of age. Take your gross income, multiply it by 5.5. You already have an idea of your borrowing capacity. Start with that. Then after, let's assume you take a mortgage of $500,000. Now, ideally, you want to have 20% deposit or cash contribution to start with. That's the ideal number. 20% of the property value plus fees, which is usually the stamp duty. As for some buyers, you get that scrapped on the several threshold and depending which state you are in. Don't want to get too technical on that, but in short, okay, you already have the goalpost. The person now have a good idea of where the goalpost is okay, I need to get my hands on $70,000 or $60,000 of deposits. Great. And most likely they will come back. So, sometime in 18 months time to 24 months time. It's my approach of working, never too early.
I think that's wonderful that you do that because there's so many people out there that are scared to take that first step, right? Yes. And the first step is always a conversation. It's not a commitment. So it's not like when you go to a bank, you have to walk away. They've got a certain target when you call them on the phone to hit. It's very different when you deal with a broker. The people you're orientated. And like about your approach, Mark, is that you're not chasing, this immediate, so you're not taking a mortgage, see you later, I can't help. It's, no, let me set you up for that next step. And young home buyers, for those of you listening who are in this category, so important to have that conversation early because you don't need to feel ashamed if you're someone who's, had some debts or had some financial issues. Like we all have been there at some point or another.
Absolutely.
And the only way to get out of that cycle is to talk to someone who understands it and can put you on a path.
And then you understand as well, who is who in the zoo and the limitations. Right. So see, as a mortgage broker, I can give advice about mortgages, the structure, and so on. And I have some legal obligations. The best interest duty is what set apart, the difference between a banker and a broker. And a lot of people say, well, it's the same, right? So think about it this way. If you go to one of the big four, let's say you go to the yellow one, the banker there is not going to tell you that the blue one across the street is offering different rates, different products, and things like that, right?
No way.
Well, first of all, to his credit, not breaking any sugar on the back of bankers, he may just simply not know. But even if he does, his boss will look at him funny if he's saying, oh no, by the way, you cross the road, for first-time buyers, I think the blue one gives you a $3,000 cash back at the moment, things like that. So brokers, on the other hand, because we have access to all those lenders, in my case, about 60 plus lenders, we have a little bit more obligations. So we need to assess your situation, of course, like a banker will do.
Yeah, of course.
But come back to you with multiple options, at least 3, and demonstrate the reasoning. Why do we go with the yellow one or the blue one? And we also suggested another lenders there. Why? And it's not down just to the rates and the fees. That's the shiny object, as I'm talking about. There's a lot of other things.
Yeah. And it makes sense. In your experience, what is the biggest misconception or knowledge gap that first home buyers have?
Well, first home buyers who bought a spectrum, I want to take a mortgage. I think a lot of people are looking at their income position, their liabilities, and from there, that's pretty much it. And they have a fair idea of this is how much I can borrow, or I can take a mortgage, or I can't take a mortgage. Yeah. There's 2 big things missing here. Which type of asset are you buying? Which type of real estate properties? It's not exactly the same thing if you're going to go and buy even a tiny little home sitting on a block
Yeah.
of land, freestanding home, as opposed to a high density shoebox apartment in a building complex with
That's true.
$300 apartment. The bank is going to look at it differently. So the valuation will come up differently. The set of rules will be different. So a lot of like first-time buyers or buyers of all forget that it's important to consider the assets you're actually buying, because that's impact. The rates you may be given, the banks you may be using. So that's things you need to take consideration. Some banks have postcode restrictions. So enter some postcodes, come back, now we don't do high density, or you need a bit more contribution. There were points where you were buying some part of Melbourne where you needed to have not 20%, at least 30% contribution. One postcode come up that there's too many high density apartments, buying an apartment there. So, and the other thing as well is not asking themselves the questions about what is it likely going to happen in my life in the next 5 years. And that's very important. It's very important because it dictates a lot about the structure of the mortgage, and you could literally hit a wall if you haven't asked yourself this question when it comes to the structure of the mortgage or the plan on back of that. So the misconception of first-time buyers is that we mentioned about the assets, we mentioned about maybe a lack of planning. Simple question about, what's going to happen in the next 5 years, maybe having aging parents, maybe overseas, like me, for example. That's mean 2 or 3 years, I will have to go back at least once a year, every year, monetary to look after my parents or things like that. Or,
of course. Or
I may have children's, in like 2 or 3 years time, or I already have children and, in 5 years time, I may want to put them in private school. That's additional expensive. So that's very important. And that's linked to what a lot of first-time buyers tend to do. And we're all guilty a bit of that, is estimate their spending. And being a little bit too optimistic about their income.
Right.
Yeah.
And I think that's also like, there's so many, what do you call it? Like mortgage calculators and finance calculators. And often some people do them and they get really put off by, what they can't do, or they get an unrealistic image of, I can do all of this. And then they are, disheartened when it's not the way it's set it on the calculator.
Yes.
So do you find that you have to do a lot of kind of educating and guiding on how to actually use those calculators appropriately? Or?
Yes. Look, a lot of education is needed for first-time buyers. You can buy a $600,000 property with $35,000 of cash contribution and not paying any LMI.
Wow.
So now that's if you were to qualify for the first-time loan deposit scheme, for example.
Yeah.
So that's one scheme. There is probably 2 or 3 government incentives at the moment for first-time buyers. Some are applicable to you. You can combine all of them. Some might not be applicable to you. So it's so complex and dense that you really need to take the moment to break it down with a broker and understand, okay, so I'm actually eligible for this and for that. We all get some good friends and catch up at barbecues and exchange ideas, and someone come at the table and said, you should be doing this, you should be doing that. Yes, okay, but really, barbecue advice is great, but go and take an expert advice. Mortgage brokers, if you want to talk about mortgage, if you want to buy multiple investment properties, build a portfolio, get a financial planners in. Don't forget the accountant as well. Understand, is it worth it? Whether it's trade-off. So get your team around. That's very important.
No, it's super important. Like I've said this on other episodes, I said it in the last one too. I said your buying team is make or break in a lot of cases. If you don't have the right support around you, it can really hinder your sale, especially if the professionals don't not necessarily know each other, but they haven't had the opportunity to get together and have that conversation. It makes a very big difference having a good team.
That's a great point that you raise, because that ideally in the ideal picture, you want a financial planner, you want your buyer's agent at some point down the track, a broker, an accountant, and you want all of them talking together. Yeah, being aware of what is the plan. If that makes sense.
It does. Like some of the quickest sales I've done in the past were when I worked really closely with, all the professionals. I always like to, but they've worked quickly because I've been able to make a quick phone call at late at night and say, I'm so sorry, is there something you can do for this client? This is the position they're in at the moment. They want to make an offer. Can you help me make this deal? And because I've got the relationship built and I know them and we're all working together, everyone just jumps in like, yeah, no problem. Like,
Yes.
give me half an hour, let me have a look. And it's incredible to have that kind of support. So as a home buyer, you're absolutely right, Mark. Get the right support around you. And I think
Yes.
accountants and, financial planner, like mortgage brokers, like these are key roles in making sure that, one, you can apply for a loan. There's your mortgage broker, that you're planning to maintain the asset is looked after through financial planning and like, what are you going to do in the next 5 to 10 years?
Yes.
And then you've got, your accountant who's like, well, hey, how's the growth of the asset and where's this going? Where's that going? How do we, strategically set you up for another purchase? So it's amazing. How important would you say it is to have realistic expectations when you're going through the purchase process, like or lodging for your home loan? Like, how do you help, I guess, as find that balance between what they want and then what they can afford?
Yes. Okay. I think I put back a little bit. I bring back a little bit the rules of the game. So, a mortgage broker, and that's very important. I'm here to tell you how much you can borrow.
Mm-hmm.
But that doesn't mean it's necessarily a good idea to borrow that much, right? Mortgage brokers are here to give you mortgage broking advice and home loans advice and tell you where the fine prints are, the catches with the banks, because there's always catches. Now, when it comes to the other part about like the balance about how much should I borrow, the question about how much should I borrow, Mark, this is a financial planner questions.
Yeah.
So the way I help first-time buyers in those situation, I pretty much told them, look, that's what you can borrow. Let's say you can borrow $1 million. Congratulations. Now, a personal opinion, because I'm not a financial planner, so I'll just give you my opinion. I think it's a lot to chew. I suggest you have a conversation with financial planners and you talk about networks. A lot of financial planners, accountants that are really good at what they do. Because of this relationship, they will pick up the phone and have a conversation with this client, potential client, without, more than that. Like I will understand your situation. I'm happy to sit down with you as a financial planner. This is where you're at. If now the financial planners come back and said, look, I had a conversation with clients, they totally understand what they're taking on and how they're going to manage it post-settlement. Remember the 5 years post-settlement
check-in.
Yeah, check-in. Then great. It's not I don't have the right to tell you what to do with your money. Unless I start moving in with you or making the repayment on your behalf. That's not going to happen. So
that's fair.
So that's the way I address it, is to identify who is who and who is here to help you.
Well, I like that you've said all this, because my next question, is, do you have a memorable like first home buyer story, like of someone that you worked with from day one to key handover? Like, I'm sure you've worked with many people, but is there one that stands out?
Look, I'm very proud of most of all my clients, and I usually build a strong relationship with all of my clients. So it's a tough question because I have a lot of great stories and I take a lot of satisfaction from that. There is one that's actually happened a couple of months ago, which I was very, very extra proud, if you want it. One of the first-time buyers, someone that's a young man on his two head on his shoulders, didn't have the best luck in life. He was on his own, pretty much. So there's no necessarily immediate relatives around and things like that. And we pretty much got him into his first home. But the journey started really came to me about what are my lending options. Okay, then we discuss a little bit like the conversation about, so how you're going to go about it, like you find your first home, how you're going to like handle the commitment moving forward, a conversation with a financial planner. He got an amazing legal party as well to assist, because initially he bought one of those properties that are a little bit securities that are a little bit tricky. There's off the plans, got it directly from the developer. What's happened often with off the plan is, back to the architecture background, delays in completing the properties. So the properties got delayed for about 4 months. So you have to mitigate all that. Eventually, he came to a point where he actually managed to get into the property with the developer with an agreement as kind of a rental. So eventually it was a bit of a journey. None of his faults. He was the first home buyers that get the first home loan deposit scheme, all the first home buyers incentive combined, pretty much. No stamp duties, no LMI, little deposit.
Wow.
Top of that, wanted to go with the lenders that don't invest in fossil fuel.
Yeah.
It is also something I have a bit of an interest on in my business. So we also find a lender that's specialized in this. So great journey. And when everything was done and it settled, it just great satisfaction when you see that, I have to communicate a lot, like with my clients, of course, but with like even with the developer at some point, because at some point he dropped the ball. Like, property should have been completed, and we keep on hearing it's getting titled. Even the streets on the street name on the contract was actually end up being changed.
Oh my God.
It could not be, having less, more related. So, big journey that's safely delivered, great outcome for him. And when I look back at that, I think, it's not that it is someone that have a lot of resources around. You don't have relatives around. You don't necessarily work in the field where you have a lot of networks as well around. So great satisfaction.
I love that story, especially someone who didn't have like all that support, in their life with relatives, and they're quite young. Like, good on them for taking the step to come and talk to someone like you. But then well done to you to actually take them under your wing and get them appropriately set up and advocate for them, like you said, with building delays. Like, that's something that technically isn't in your wheelhouse to do, but
yes,
you do it because you love what you do, and that comes out so clear in this interview. So I really appreciate that.
Yes, and then just on this, not just to add, because just refresh my memory on that. They were a little bit of a conflict of interest as well with the real estate agent and the developers at the time. So you really don't have much luck on it. But now all good, it's settled, and the property is great.
I'm so glad. Good happy ending to that one. And I want to switch gears to investor finance strategy, right?
Yes.
Because we've talked about our homeowners, like the owner-occupier space and first-home buyers, but things are different when you come to investment side slightly. So what are some of the most common mistakes that property investors make when it comes to financial structure?
Yes. So common, hopefully it's not too common, but I've seen it, and that really hurts. So really not having the right structure for an investment lending. So it comes down to the thing. I will start with the structure. And a very simple example, actually, I had a client like this two years ago. That came, he was a little bit upset. He came to the office with nearly $1 million worth of lending, investment loan, that was no longer tax deductible.
Oh my God.
How did that happen? He had a broker, old-timer broker, so I think he's no longer in the industry now. Anyway, when he took on the mortgage, this person was working in trades, and he was having this investment properties set up with a basic loan, no offset, and he was having good cash flow, right? So he pumped up like a withdrawal into the home loans. Yeah. And what happened when you do that and you have some withdrawal on an investment debt, if you withdraw the cash but spend it on the personal spending, let's take an example, let's say it's me, I go and have like $50,000 withdraw in my investment home loans. I take $10,000 out to pay for a trip overseas, plane ticket and so on. I put this money back into the home loans after. This $10,000 is no longer tax deductible. So if you do that over a long period of time and you take money out, money in, money out, money in, you can actually make your investment home loans no longer tax deductible.
Wow.
How to just go about that? All that you needed to have is to have an offset account set up. Because if you have an offset account, it doesn't impact, it protects the tax deductibility of your investment home loans. So an offset account, I know it sounds technical for some people, but it's very simple. It's a transaction account. Yeah. Like you have the debit card on it that have a button offset. So it just link against your mortgage there. So you put all your cash, instead of putting it into the home loans, you put it into the offset account.
Yeah.
And you can withdraw and put back money as you please on this offset account. It doesn't impact the tax deductibility of your investment home loans. So that's all that needed to be done. He went like this for a couple of years until his accountant said to him, well, sorry, this is no longer tax deductible.
Wow.
So that's one easy mistake that can be done, and that will have happened with not so good communications
Of course.
with the brokers or with the banker that didn't really explain how an offset account works and why is it beneficial to have an offset account. One of your hosts in some previous podcasts, you asked her a question, offset. She said all the way, validate that as well. 99% of the time, there is the 1% where sometimes having an offset, it's not great. And this is when you don't use the offset.
Yeah, of course.
You have a bit of a spending problems. You may settle, you may have a bit of equity, a bit of cash out that you leave on the offset to reduce your interest payable. That's great. But you have a bit of a spending issues. The 100K that you had from day one after the settlement, 3 months later, it's all gone. It's not gone on thing. Then in that case, financial planner will tap me on the shoulder and said, can we remove this offset because it's just too easy for the client to just spend it.
Yeah.
So in that case, let's disconnect the offset account, so at least if they want to take some money out, they have to literally go on their app and take it out of the withdrawal from the mortgage and just make it a little bit less easy.
Yeah, it's like make it a bit harder.
But overall, the offset account is a good choice. With investment, it's a must. Because of what I've mentioned with the tax deductibility.
Yeah.
And obviously, if you have an offset and you use it, you're going to repay your mortgage much faster.
Yeah.
Because you reduce the interest payable without making any physical repayment.
You go.
So if you go to Google and say, how do I repay my mortgage faster, my debt pledge faster, without making additional repayments, they will usually come up with set up an offset. Just say yes, but make sure you use it.
Yeah, that's right.
And understand the trade-off. Sometimes you have a discount on the rates with an offset, but you would usually be charging a fees for having an offset facilities, $300 or $400 a year, something like that. Not a big deal in the scope of things. And if you use it,
if you use it,
you recoup the saving in interest, really offset that by miles. So
there you go. And I think that's a good one for people listening at the moment who have heard, because you hear the term offset and, often someone doesn't take the time to explain, okay, well, what is it and how does it work? And I think you did a really nice explanation of that.
So that's one example. If I could add also another thing for investors is to understand as well the structure and really having, and this is why you need a financial planner when you start really building up a portfolio of investment properties, is understand the timing. So if you're going to buy one investment properties and you plan to build up a portfolio, you need to have the right structure for that, because most likely than not, in 2 or 3 years' time, when you buy the next investment properties, you may need to do something with the existing mortgage, restructure it, refinance it, or at least restructure it a certain way to increase your borrowing capacity for the next properties. Little things like that. So if you structure it wrong to start with, let's say you put a fixed rate for 5 years, and that there's some changes coming in regard to this space. Well, if you fix with a bank, you're committed with this bank for this period of time, and there's some restrictions where there's some break fees if you have to change banks and so on. So that's the second thing to be aware of.
Well, I think you answered my next question, which was, the financial structure, right, around this. And you mentioned that a lot of your investor clients, like this is when we were talking in the pre-interview, come through buyer's agents or financial planners.
Yes.
What role does the team approach play in making these strategies successful? I know we touched on this earlier, but I thought,
Look, I have a very simple image if you want.
Go for it.
Imagine we are in a James Bond movie.
Okay, nice.
Imagine that. So if you're going to buy investment properties and portfolio, imagine the roles of the characters are like this. Your financial planner is M in the James Bond. He's the big strategist up there, the head of MI6, said, this is the mission. My clients, we're going to build a portfolio of investment properties over the next 5 years. Us, mortgage brokers, we're a little bit like the 00 agents. Said, okay, we're going to go and bash some banks, get ourselves get the money on the table so we can make that happen. But we can't do it on our own. We need some other expert to help us.
Back up.
We need Q. Q will give us a weaponry. Who is Q in the scope of things? Your legal party. Your conveyancer.
Yeah.
Very important, more important than a lot of people think. There's a lot of things in the contract of sale. There's a lot of things that could be missing or should be in the contract of sale. I have very good lawyers that often say, what's important is what is in the contract, but also what is not in the contract.
That's true.
That can really save you. Give me some additional weaponry. Best in building inspection, finance close or not, but at least we know that we're in the cooling off period, all this kind of thing. So Q come into play, the lawyer. And then once we all sort it, we break into the bank or discuss the bank, we get our approval, we all sorted on that. Then we need to get the target, right? We need to hit the target.
That's right.
And this is where the buyer's agent came in. The specialized snipers said, okay, what's the brief? Well, M up there, the financial planner, told us that we need a $500,000 properties with a yield of like 3.5%, net. By the way, it needs to be in WA. Fine. The buyer's agent come into play. They never missed a shot. The perfect snipers. They shot from miles away, sometimes target that are not even in sight, the off-market properties.
Nice.
And they take the emotion out. They march on orders.
Yep.
Have the shot. Take the shot. Boom. And you pretty much have now a picture about where the clients sit in all that is, sorry for the stereotype, but the damsel in distress pretty much. So that's the mission. And when that's accomplished, that's on. So see where I'm going with that.
I really like
financial planner up there. Mortgage broker, well, we deal with the bad guys, the banks. I don't work for them, so clear. No, I put it in my motto, Marc Cam loans, we work for you, not for the banks. Now, I get paid by the banks, thank you very much, but they're not in the charity, they're not in charity business.
Yeah.
They would make you sign a death pledge, that's fine. We need to understand what is in it and what we're signing for, and that's fine.
Yeah.
But did I give you a bit of an image?
Oh, I love the image. That's why I wanted to ask the question, because I thought you might have something up your sleeve. I really appreciate that. And I think it's a good visual, especially for a podcast when you've got people that are trying to picture this in their head. They're now going to look at every James Bond movie and go, oh, look, my buying team.
Perfect. Yes.
That's it. And, before we get to the next section, I just want to, ask this part here. So, do you find that newer investors are too focused on quick wins or short-term gains, like where they're looking at just trying to turn something around quickly and get cash back in their pocket, and they want it done in a small time frame?
Well, I think that's a bit everyone, isn't it? When you in investments, you usually a bit over optimistic, and of course you feel like I'm going to have a quick win. Not the financial planners, but based on communication I have with them and so on, and talking a lot about the topic. The reality is investments takes time to get a good return on investment. The quick win, it's a bit utopic, to be honest. It can happen in the flux.
Yeah.
Most likely than not. It will be challenging if you think about it, to really make significant gain over less than 5 years' time.
Yeah.
You need a bit of time for the mechanic to take on. And then from there, I think it's probably diversifying is the key word. So do I find that new investors are a little bit too optimistic? Probably. But it's very, very much human.
Of course. Like we think we're going to get into it, we're going to make $1 million tomorrow, and we're going to leave and say that was a good idea. And often property's a long game, and that's why it's important that when you're setting up that financial team, going back to the last question, that it's someone that's with you. They're in it for you for the long haul.
Yes.
It's not just one property to acquire it. You're going to hopefully, if you had a good experience, go back and use them all the time for future planning, maintenance, the whole lot.
But overall, we're investment. That is real estate or even shares and so on. You need to let it sink a little bit, especially at the beginning. Like after a couple of years, then another French word, the mayonnaise start to take on. But you need to leave this first few years sink in first.
Oh, yeah, of course. And Marc, I've thoroughly enjoyed this discussion with you today. Thank you so much for being here. Before we wrap up, I have more questions, the last 3 questions here. What's one myth about mortgage brokers that you want to bust?
I think one of the myths of the myths up there about mortgage brokers is not too many people know that you will never receive an invoice from me or from most mortgage brokers.
That's a good point.
That's very important. So it costs you nothing to get in front of a mortgage broker.
Yeah.
Literally. It just costs you 30 minutes of your time. And you probably know more than the average banker. I guarantee you that by the end of the meeting. And the other thing, so that's one of the misconceptions. The other thing is, so we get paid by the banks. It's important. I always explain to my clients how I get paid. So I get paid by the banks. So they pay me a commission. It would be natural to think, well, in that case, the brokers is getting paid by the banks. I'm probably worse off somewhere. Maybe I'm not getting the best rate. I should be better treated by going to the bank direct and things like that. And I said to them, very transparent on that. I said, well, it's a different channel. That's all that it is. Instead of opening a branch and having to pay for 50 staff salaries, trust me, the bankers, when you go and make a loan with them, they'll tell your team, get a bonus and so on. So actually using a broker is not a bad deal for the banks. And also mortgage brokers carry on the liabilities as well. He needs to do well more than the banker. He has more legal obligation. So there is no catches in using a broker. A lot of people, and I have a perfect example that just come up, a lot of people think that because they've been with their bank for 5-10 years, they get a special treatment. Now I'm going to put it up there. It's very simple. The banks love you while they don't have you. When they have you, they forget about you. And I had an example actually that came this week, which is fantastic. Fantastic. Just show how dysfunctional the banks are, but it illustrates this example perfectly. It's one of the big four. I won't name it, but the one that tend to be a little bit more dysfunctional. It's not the yellow one. That's the only thing I would say. So it's another one. Now, hear that. The clients came to me, prospective client, he will be a client most likely. And he currently have his mortgage that he took on 7 years ago. Now, part of what we do, and we can do that, doesn't cost anything to our clients, is we'll approach their bank and squeeze them a little bit and say, look, what is the best rate you can give to a client? So that's called repricing their current home loans, right? Clients are long-time clients of this lender. It's important to note that he's a police officer, and that will become interesting in the story. Now, we approach the banks, with the authority of the clients, with the statements and so on. Banks come back and said, we don't have this client. We can't find this mortgage in our system. Then it came back with something that the client, I think, was seen as overseas client or something like that. So it doesn't really make sense. He's a police officer, so one of the prerequisites is you need to be Australian. Anyhow, eventually the solution was now for the clients to go to the branch to identify himself to the branch. Now, he's been a client for 7 years with this bank. When I asked my BDM, so how is this? Tell me what happened. How is it possible that you don't know that he's kind of exists, that he's there, and now he needs to go and present himself in the branch to be identified? I said, well, this is what happened, Mark. And that's what my BDM telling me this. He said, back in the days when he took on the mortgage at the branch, when they did the verification of ID or whatever, they missed on ticking one box, Australian citizen. That's it. That's all that it took. So it just shows like the client's been a long-term client of the bank. He's a police officer, which is ironic because therefore he is for sure an Australian citizen. And in the paperwork or whatever, when they did the application, they just, whoever was pushing the button on the side of the bank just missed to tick one box. And that's now lead the clients that you have to go to a branch and so on, just for us to reprice the mortgage. So do you think that a bank that doesn't even know who is who in their own clients, the banker is going to call him anytime soon and say, by the way, I'm going to renegotiate, I'm going to give you good news, your rate is going down and so on. They don't even know you exist.
Yep, it's true.
It was like, remember this, there's no loyalty with banks.
I like the way you put that. And I think that you called out really solid ones that I even had forgotten about.
I keep a little book when I retired and finished my careers. Not the malpractice, but funny things I've seen with the banks. I think that's really. You're
going to have a comedy routine, I think, one day.
Yeah. So dysfunctional things I've seen. Okay, so police officer is an overseas person now. Okay, cool.
So we'll just write that down.
Little things like that.
And look, one of the last questions for you, Marc, is, if someone came to you today with a $600,000 budget and no clue where to start, what would you tell them?
Start by having a conversation with us, with our mortgage brokers, to understand all the incentive that, if you're first-time buyers, that you may be entitled to, and know where the goalpost is. So start with a broker. Ideally, I would say start with a financial planner, but a good broker will have a relationship with financial planners or the contact and network to put you in front of the next person that you need to have a discussion with. But yes, be proactive. I mean, it's great to look at realestate.com and it's exciting.
Yep.
But you will save yourself a lot of time and potentially a fair bit of money by being a bit proactive. Don't be, as you mentioned before, don't be scared to have this conversation. Even if you don't have a job now or whatever, at least you know where to start. Yeah.
That's solid advice. Marc, thank you so much for sharing your experience, your strategy and your story, from architecture, to property management, mortgage broking. I think that's just such a unique background and part of the reason why I wanted to talk to you today, because if any of you out there are listening who feel a bit misunderstood, or maybe you've wanted to get into the property game, talk to someone, talk to Marc. It's not going to cost you anything, like you said. It's a conversation, and it's a conversation that could set you up for life if you have the right one and the right guidance and team around you, your James Bond team
Absolutely.
When you get your death pledge. So
absolutely.
We've all learned French today. I think everyone's going to be blown away by that. But again, Marc, thank you for coming in. And for our listeners, I hope you're walking away with a bit more clarity around how strategy should drive your property journey, not just ideas, especially if you're a first-time buyer or someone of thinking starting your investment journey. And Marc, lastly, if our buyers, or our listeners want to get in touch with you, what's the best way to contact you?
Oh, look, the best way is feel free to Google Marc Cam home loans, pretty much up there. We're very reactive and accessible. Send me an email or give me a call. We always return calls or picked up when available. So we're here to help, and maybe it doesn't cost you anything. So
that's the biggest perk. So, look, thank you everyone for tuning in. And thanks again, Marc. If you loved this episode, don't forget to leave a follow, leave a review, or share it with someone who's about to start their home buying journey. This might actually save them a lot of stress and a lot of thinking. And of course, if you want to get in touch with Marc, we'll drop his details in the show notes below, and you can reach him on his website. But until next time, guys, keep it real, keep it strategic, and as always, no BS. That's a wrap for this episode of the No BS Real Estate Podcast, powered by Abodey AI. If you found this conversation helpful, don't forget to subscribe, leave a review, and share this episode with someone who might need it. If you're looking for more guidance on your home buying journey, you can visit www.abodey.com.au for expert advice, property insights, and the tools you need to find the right home with confidence. If you're already on your journey, you can also download our app. Just search Abodey AI on the App Store or Google Play. Have any questions or want to connect, you can follow us on Instagram at abodey.com.au or send us a message. We'd love to hear from you. Thanks for tuning in, and we'll catch you in the next episode.